Let's begin with something simple. Imagine a table. A plain wooden table, nothing special about it, maybe a little uneven on one leg so it wobbles slightly when you lean on it. And behind this table sits a man. He's been sitting there since dawn. He'll be sitting there until dusk. He does this every day. He has been doing this, more or less, every day for most of his adult life. On one side of the table is a small pile of coins. On the other side, a ledger, a record of what he's bought and what he's sold. The man doesn't make anything. He doesn't grow anything. He doesn't build anything. He simply sits, and when someone approaches, he quotes two prices. A price at which he'll buy. A price at which he'll sell. The difference between those two prices, a small gap, never too wide, never too narrow, is how he makes his living. This man is a market maker. And his story is one of the oldest, quietest, most important stories in the history of civilization. It is also, truthfully, one of the most boring. Which is why no one has ever really told it properly. So let's do that now. We should start in Mesopotamia, because most things do. Around 5,000 years ago, in the Fertile Crescent between the Tigris and Euphrates rivers, in what is now Iraq, the first cities were forming. Uruk, Ur, Lagash. These were places where, for the first time in human history, large numbers of people lived close together and needed things from each other. A farmer had barley. A herder had goats. A potter had clay vessels. A weaver had cloth. The problem, of course, was exchange. If you had barley and wanted a goat, you needed to find someone who had a goat and wanted barley. Economists call this the double coincidence of wants, which is a very academic way of saying that barter is annoying. The solution, eventually, was money, standardized measures of silver, weighed on small scales, used as a medium of exchange. But money created its own problem. If you were a merchant arriving from another city, your silver might be of a different purity or weighed using different standards. You needed someone to evaluate your silver, exchange it for the local standard, and give you something you could actually spend in the market. Enter our man at the table. We don't know what the Sumerians called him. The records are fragmentary, clay tablets, mostly, many of them broken or eroded over millennia. But we know he existed because we have the transaction records. Small clay tablets documenting exchanges, this much silver for that much barley, on this date, witnessed by these people. The prices quoted. The quantities exchanged. And in many of these records, there is a small discrepancy. The price at which silver was acquired is slightly lower than the price at which it was sold. The difference is small. Consistent. Deliberate. That difference is the spread. And it has been the heartbeat of market making for 5,000 years. Now, let's move forward a few thousand years to Rome. Because Rome is where things get interesting, or rather, where things get organized, which in the history of market making is more or less the same thing. The Roman Forum was many things: a political meeting place, a religious center, a venue for public speeches and executions. But it was also, fundamentally, a marketplace. And in the marketplace, along the edges of the great open square, you would find the Argentarii. The Argentarii were money changers. But calling them money changers is a bit like calling the ocean a puddle. It's technically accurate but misses the scale entirely. Rome, at its height, was a vast empire spanning from Britain to Egypt, from Spain to Mesopotamia. Dozens of currencies circulated within its borders. A merchant arriving from Carthage might carry Carthaginian shekels. A trader from Athens would have drachmas. A soldier returning from the eastern frontier might have a pouch of Parthian coins. All of these people needed to convert their foreign money into Roman denarii, the standard currency of the empire, before they could buy or sell anything in the city. The Argentarius sat at his table, his mensa, from which we get the word, well, mensa, but also, indirectly, the concept of a financial counter or desk. He would examine the foreign coins, assess their silver content, biting them, sometimes, or scratching them against a touchstone, and then quote two prices. The price at which he would buy the foreign coins. The price at which he would sell Roman denarii. The gap between these prices was his profit. Now, the important thing about the Argentarius was not just that he exchanged money. It was that he was always there. Every day, from the opening of the market to its close, the Argentarius sat at his table and quoted prices. Rain or shine. Festival or funeral. Whether the market was busy or quiet. Whether coins were plentiful or scarce. This consistency, this willingness to always be available, to always quote a price, to always take the other side of a transaction, was the Argentarius's real contribution. He provided what we now call liquidity. The assurance that if you wanted to buy or sell, you could. Right now. At a known price. Without having to search for a counterparty. It sounds simple. It is simple. But it is also, quietly, one of the most important services in any economy. An economy without liquidity is an economy where transactions are slow, uncertain, and expensive. An economy with liquidity is one where things flow. Goods move. Prices are discovered. Commerce happens. The Argentarii made Rome flow. They also, over time, developed something more sophisticated than simple money changing. They began to accept deposits, to make loans, to transfer funds between cities using written instructions, an early form of the bill of exchange. A merchant in Rome could deposit coins with his Argentarius, receive a written note, travel to Alexandria, present the note to an associated Argentarius there, and receive local currency. This was, in essence, banking. And it grew directly out of market making. The Argentarius started by sitting at a table and quoting two prices. He ended by creating the financial infrastructure of an empire. Eventually, of course, the empire fell. The Argentarii disappeared along with it. Their tables were abandoned. Their ledgers were lost. For several centuries, organized market making in Europe more or less ceased to exist. But the idea, the simple, boring, essential idea of a person sitting at a table, quoting two prices, survived. Because it always does. Let us move now to medieval France, to a region you have almost certainly heard of but probably associate with wine rather than finance. Champagne. In the 12th and 13th centuries, the county of Champagne hosted a series of trade fairs that were, by the standards of the medieval world, enormous. 6 fairs per year, rotating through 4 towns, Troyes, Provins, Lagny-sur-Marne, and Bar-sur-Aube, running almost continuously. Merchants traveled from across Europe to attend. Italians bringing silk and spices. Flemish traders bringing wool and cloth. English merchants bringing tin and lead. Germans bringing furs. The fairs lasted for weeks at a time, and they followed a precise schedule. The first few days were for setting up, unpacking goods, erecting stalls, greeting acquaintances you hadn't seen since the last fair. Then came the days of trading in cloth. Then the days of trading in leather and furs. Then the days of trading in spices and other goods measured by weight. And then, at the end of each fair, came the most important days of all, the days of settlement. The days when the money changers sat at their tables and balanced the books. Because here was the problem. An Italian merchant had sold silk to a Flemish buyer, but the Flemish buyer paid in Flemish pounds. The Italian merchant needed Florentine florins. A German fur trader had bought English tin, but paid in marks. The English merchant needed sterling. The money changers at the Champagne fairs, many of them Italians, from Lombardy and Tuscany, would sit at long tables in a designated area of the fair and quote exchange rates. Florins for pounds. Marks for sterling. Deniers for ducats. Dozens of currencies, dozens of exchange rates, all quoted simultaneously, all adjusted throughout the day based on supply and demand. The scene must have been remarkable, in its way. Dozens of men sitting at tables piled with coins from across Europe, calling out prices in a mixture of French, Italian, Latin, and whatever other languages were needed. The clink of metal. The scratch of quill on parchment. The quiet, methodical work of converting one form of money into another, one transaction at a time. It was boring work. Essential work. The kind of work that held an entire continent's commerce together, and that almost no one outside the fair ever thought about. I could continue for some time about what happened next, about the Medici Bank, which opened in Florence in 1397 and operated branches across Europe, each one functioning as a market maker for local currencies. About how the Medici kept meticulous records of every exchange rate, every transaction, every outstanding credit, and used this information to adjust their spreads, widening them when they held too much of one currency, narrowing them when they needed to attract deposits in another. I could tell you about how the word bank comes from banca, the Italian word for the bench or table at which these money changers sat today. And how, when a money changer went bankrupt, when he couldn't meet his obligations, his bench would be physically broken. Bancarotta. Broken bench. Bankrupt. I could describe the trading rooms of Renaissance Venice, where currency dealers gathered at the Rialto, yes, the same Rialto from Shakespeare, and quoted exchange rates in a formal, ritualized process that hadn't changed much since the Roman Forum, but was now conducted with slightly better accounting. But I think you can see the pattern by now. A person sits at a table. They quote two prices. They manage their inventory. They earn the spread. The table is in a different city each century, and the currencies have different names, and the ledgers evolve from clay tablets to parchment to paper, but the job is the same. Always the same. So let's skip ahead a bit. Let's go to London. In the late 17th century, London had a coffee problem. Which is to say, London had too many coffeehouses, and the coffeehouses had too many people in them, and the people had too many opinions, and some of those opinions were about the price of stocks. Jonathan's Coffee House, in Change Alley near the Royal Exchange, was where stockbrokers gathered. It was noisy, crowded, thick with tobacco smoke, and perpetually sticky with spilled coffee. The coffee, by all accounts, was terrible. But nobody came for the coffee. They came to trade. England, in this period, had recently discovered the joint stock company, a way of pooling capital from many investors to fund large ventures, particularly overseas trading expeditions. The East India Company, the Royal African Company, the Hudson's Bay Company. Shares in these companies could be bought and sold, and Jonathan's Coffee House was where the buying and selling happened. The dealers, we would call them market makers, would stand or sit in the coffee house and call out prices. East India at 174, selling at 178. Anyone in the coffee house could take the other side of the trade. The dealer would record the transaction in his book. Money and share certificates would change hands later, sometimes at the coffee house, sometimes at a nearby tavern. There was no formal exchange. No rules. No regulation. Just men in a coffee house, quoting prices, making markets. This worked surprisingly well for quite a long time. A man named John Castaigne began publishing a twice-weekly price list, the course of the exchange and other things, which standardized the information available to traders. The list included stock prices, commodity prices, exchange rates, and other financial data. It was the Bloomberg terminal of its day, except printed on a single sheet of paper and available for a few pence. The system also, inevitably, produced the world's first major stock market bubble. The South Sea Company was chartered in 1711 to trade with South America. It didn't actually do much trading with South America. The Spanish controlled most of the territory and weren't particularly interested in sharing, but the company's directors were very good at something else entirely, generating excitement. Through a series of increasingly creative financial maneuvers, the South Sea Company's stock price rose from about £128 in January 1720 to over £1,000 by June. Everyone was buying. Servants. Duchesses. Members of Parliament. Sir Isaac Newton, who bought early, sold at a profit, then bought back in at the top because he couldn't stand watching other people make money. The market makers at Jonathan's Coffee House were quoting prices the entire time. Buying and selling. Maintaining liquidity. Earning the spread. And then, in August and September of 1720, the price collapsed. From £1,000 to under 200 in a matter of weeks. The market makers who had been holding inventory, who had been buying shares all the way down because that was their job, to provide liquidity, to be the buyer when everyone else was selling, were destroyed. Many went bankrupt. Their benches were broken, metaphorically if not literally. The lesson was familiar, and would be relearned many times. Providing liquidity is a wonderful business, right up until the moment it isn't. And the moment it isn't is always the moment that you have the most of the thing that nobody wants anymore. I should tell you about the New York Stock Exchange, because it is, in some ways, the most complete expression of the market-making idea that has ever existed. On May 17, 1792, 24 stockbrokers gathered under a buttonwood tree on Wall Street in Lower Manhattan and signed an agreement. They would trade securities only with each other. They would charge a minimum commission. They would, in effect, form a club. This club became the New York Stock Exchange, and for nearly 200 years, it operated on a system called the specialist. Each stock listed on the NYSE was assigned to a specialist, a single firm responsible for maintaining an orderly market in that stock. The specialist stood at a designated post on the trading floor, kept a book of all outstanding buy and sell orders, and quoted bid and ask prices. The specialist's obligation was absolute. They had to trade. If there were sellers but no buyers, the specialist had to buy, using their own capital. If there were buyers but no sellers, the specialist had to sell, from their own inventory. The specialist was the market maker of last resort. The person who was always there. The modern incarnation of the Argentarius at his table. The trading floor of the NYSE, in its heyday, was a remarkable place. Hundreds of specialists standing at their posts. Brokers scurrying between posts, carrying orders. The roar of voices calling out prices. the ticker tape machines clattering in the background, sending price information to offices around the world. It was loud. It was chaotic. And it was, underneath the chaos, surprisingly orderly. Because at every post, there was a specialist. And the specialist was always quoting two prices. Always ready to trade. Always maintaining the market. This system, the specialist system, lasted, in various forms, from 1792 until the early 2000s. Over 200 years. It survived wars, panics, depressions, scandals, and technological revolutions. It survived because it worked. Not perfectly, specialists were occasionally corrupt, sometimes incompetent, frequently overpaid, but reliably. The market opened every morning. Prices were quoted. Trades were executed. Liquidity was provided. And then, quietly, it ended. The machines came gradually, and then all at once. Nasdaq, founded in 1971, was the first fully electronic stock market, no trading floor, no specialists, just computer screens showing bid and ask prices from competing market makers. It seemed like an oddity at first. A market for smaller, less prestigious companies. Real stocks traded on real exchanges, with real people standing at real posts. But the screens were faster than the people. The screens didn't take lunch breaks. The screens didn't have bad days. And the screens, over time, attracted the kind of people who were very, very good at building things that were even faster than screens. By the early 2000s, algorithmic trading firms, companies like Getco, Knight Capital, and later Citadel Securities and Virtu Financial, had built systems that could do everything a specialist did, but faster and cheaper. Quote bid and ask prices. Manage inventory. Adjust spreads based on market conditions. Execute thousands of trades per second. The specialist, who had stood at his post on the NYSE floor since 1792, was replaced by a server in a data center in New Jersey. The server did the same job. Faster. Cheaper. Without needing lunch or a bathroom break. The spreads, the gap between the buy price and the sell price, the market maker's profit, compressed dramatically. In the specialist era, the minimum spread on a NYSE stock was 12.5 cents, later reduced to 6.25 cents. The electronic market makers compressed spreads to a penny, then to fractions of a penny. This was, by any reasonable measure, a good thing for investors. Lower spreads meant lower costs. Every trade was a little bit cheaper. Over millions of trades per day, the savings were enormous. But it also meant that market making was no longer a business for humans. It was a business for machines. And the machines were engaged in an arms race of extraordinary intensity. Companies spent millions on co-location, placing their servers physically next to the exchange's matching engine, so that their signals would travel a few feet instead of a few miles. They built microwave towers, chains of antennas stretching across the countryside, transmitting market data at nearly the speed of light, slightly faster than fiber optic cables. They hired physicists and mathematicians to optimize every microsecond of their trading systems. The amount of human brilliance devoted to making a market-making algorithm 3 microseconds faster than the next one is, depending on your temperament, either inspiring or depressing. Perhaps both. And then, on May 6, 2010, the machines did something the specialists had almost never done. They walked away. The flash crash of 2010 lasted about 36 minutes. In that time, the Dow Jones Industrial Average dropped nearly 1,000 points, about 9% of its value, and then recovered almost completely. During those 36 minutes, some individual stocks traded at absurd prices. Accenture, a consulting firm worth billions of dollars, traded at 1 cent per share. Apple, the most valuable company in the world, reportedly traded at $100,000 per share. What happened was, in simplified terms, a large institutional seller placed a massive sell order. The algorithmic market makers, sensing unusual selling pressure, began pulling their quotes, widening their spreads, reducing the sizes they were willing to trade, or simply turning off entirely. As the market makers withdrew, liquidity evaporated. There were sellers, but increasingly few buyers. Prices fell. The falling prices triggered more selling. More market makers withdrew. Prices fell further. In 36 minutes, the electronic market makers demonstrated both their strength and their fundamental weakness. They were brilliant at providing liquidity when times were good, when markets were calm, when order flow was balanced, when the world made sense. But when things went wrong, when uncertainty spiked, when the algorithms encountered conditions outside their training data, they simply stopped. The old specialists, for all their faults, had an obligation to trade. They couldn't just walk away. The machines had no such obligation. They were profit-seeking entities, not public utilities. They provided liquidity because it was profitable, and they stopped providing it the moment it wasn't. After the flash crash, regulators implemented new rules, circuit breakers, limit-up limit-down bans, and other mechanisms designed to prevent a recurrence. The rules helped. But they didn't solve the fundamental problem. Market makers provide liquidity voluntarily, and voluntary things can stop. And now we arrive at the most recent chapter, which is also, in a strange way, the oldest. In 2018, a young developer named Hayden Adams published a protocol called Uniswap. The idea was radical in its simplicity. Instead of a person or an algorithm quoting prices, a mathematical formula would determine the price of any asset. Instead of a market maker managing inventory, a pool of funds, contributed by anyone who wanted to participate, would serve as the liquidity. The formula was X times Y equals K. Where X was the quantity of one asset in the pool, Y was the quantity of the other, and K was a constant. If someone bought asset X, the quantity of X in the pool decreased, the quantity of Y increased, and the price of X went up. If someone sold X, the opposite happened. There was no market maker. There was no specialist. There was no person sitting at a table. There was just the formula, and the pool, and the math. And yet, in the most fundamental sense, it was the same thing. Liquidity was being provided. Two prices existed, a buy price and a sell price. A spread was earned by the liquidity providers. Inventory was managed, automatically, by the formula, but managed nonetheless. 5,000 years after a Mesopotamian money changer sat between a goat farmer and a barley grower, the job was being done by a smart contract on a blockchain. No table. No bench. No coffeehouse. No trading floor. Just code. A few years later, an updated version, Uniswap v3, introduced something called concentrated liquidity. Instead of spreading funds across all possible prices, liquidity providers could focus their capital within a specific price range. I'll provide liquidity for this asset between this price and that price. This was, if you step back and squinted, the reinvention of the specialist. A person, or, more often, an algorithm, choosing a range, committing capital, earning fees within that range, and going idle outside it. Just like the specialist at his post, quoting a bid and an ask. Just like the Argentarius at his bench in the forum, buying and selling within the day's range. Just like the Mesopotamian, sitting between two people who each had what the other wanted. The technology was unrecognizable. The principle was identical. I want to end with something quiet. The history of market making is not a history of great events. There are no battles. No revolutions. No moments of soaring drama. It is a history of people, and later machines, and later mathematical formulas, sitting in the middle of transactions, providing a service so fundamental that it is almost invisible. When you buy a share of stock, you probably don't think about the market maker who sold it to you. When you exchange currency at an airport, you probably don't think about the centuries of financial evolution that made that transaction possible. When you swap one token for another on a decentralized exchange, you almost certainly don't think about the Mesopotamian money changer who did essentially the same thing 5,000 years ago. Market makers are the plumbing of the financial world. Nobody thinks about plumbing until it breaks. And when it works, when liquidity flows and prices are fair and transactions happen smoothly, nobody notices at all. But the plumbing is always there. It has always been there. From the dusty markets of Mesopotamia to the marble halls of the Roman Forum. From the muddy fairgrounds of Champagne to the smoky coffeehouses of London. From the raucous trading floors of Wall Street to the humming data centers of New Jersey. From the data centers to the blockchain. Someone sits in the middle. They quote two prices. They earn the spread. It's boring. It's essential. It's been happening for 5,000 years. And somewhere tonight, on a server, in a smart contract, in a formula that runs without pause and without sleep, it's still happening. Right now. This very moment. A buy price. A sell price. The spread. Always the spread. Good night.